A company can report millions in net income and still face immediate bankruptcy. Profitability on paper does not guarantee a firm has actual cash. The income statement measures economic performance using accrual accounting. It records revenue when it is earned and expenses when they are incurred, regardless of when money actually changes hands. This creates a dangerous gap between reported profit and the actual cash sitting in the bank. To bridge that gap, analysts rely on the statement of cash flows. It is the ultimate diagnostic tool, designed specifically to strip away non-cash accrual distortions and show exactly where the money is going. This statement performs three specific evaluative functions. It assesses a company's liquidity, its solvency to meet debt obligations, and its overall financial flexibility. While accrual accounting outlines a company's theoretical profitability, true corporate survival is measured exclusively by the mechanical realities of cash. The mathematical purpose of the statement of cash flows is straightforward. It explains the exact change in a company's cash and cash equivalents during a specific period, reconciling the beginning balance to the ending balance. Looking at this statement, it sorts cash movements into three categories. Operating activities derive from the firm's principal revenue-producing engine. Investing activities track capital deployed to acquire assets. Financing measures transactions relating to debt and equity. Summing these reconciles the beginning and ending balance. This categorized format is a strict accounting requirement, but its utility goes further. It provides a detailed map showing exactly how management chooses to source and deploy its most critical asset. Let's clear the periphery, investing and financing, before tackling the complexities of operations. In the investing section, common cash outflows include acquiring property, plant, and equipment, or making long-term loans to other parties. Conversely, investing inflows occur when a firm sells those long-lived assets or collects cash from the maturity of another entity's debt instruments. Over in the financing section, cash inflows represent capital acquisition. This includes obtaining resources directly from owners by issuing equity, or securing cash from creditors by issuing bonds and long-term loans. Financing outflows happen when that capital is serviced or returned. This covers the cash repayment of borrowed amounts, the distribution of cash dividends, or cash spent to repurchase the entity's own shares. There is a strict exception here for non-cash investing and financing activities, such as converting debt directly into equity. Because these transactions affect assets or liabilities without actually moving cash, they bypass the cash flow statement entirely and must be disclosed separately in the financial notes. Investing and financing activities dictate the firm's future capacity and capital structure. They are highly significant, but they represent distinct episodic events completely separate from the daily core engine of the business. To evaluate that core engine, we use the indirect method, also called the reconciliation method. This is the primary mechanism for calculating operating cash flow, and instead of tallying raw cash receipts, it starts with the net income figure. The indirect method works by reverse engineering the cash flow. It systematically strips out all the non-cash items, deferrals, and accruals embedded in net income, walking backward until only the pure cash remains. This table outlines the complete logical framework of rules used to execute these reconciliations. The first rule addresses non-cash expenses and losses, such as depreciation and amortization. Depreciation artificially lowers reported net income on the income statement, but no actual cash ever left the business to pay for that expense this year. To find the true cash flow, that exact value must be added back to the net income. Next, the framework isolates items included in net income whose actual cash effects belong in the investing or financing buckets, like a gain on the sale of property. When property is sold, the entire cash proceed is reported down in the investing section. If we left the paper gain in the operating section, we would be double counting it. Therefore, the gain must be subtracted from net income. The framework then adjusts for changes in working capital, starting with current operating assets, like accounts receivable and inventory. These follow an inverse logic. An increase in accounts receivable means revenue was recorded on the income statement, boosting net income, but the cash has not been collected from the customer yet. That uncollected amount must be subtracted. Finally, the rules adjust for changes in current operating liabilities, such as accounts payable. Here, the logic is direct. An increase in accounts payable means an expense was recorded, reducing net income, but the cash has not been paid to the vendor yet. Because that cash was conserved by the business, it gets added back. The indirect method is a rigorous purification process. It extracts the raw, mechanical cash reality from a highly theoretical accrual construct. Let's apply this logic directly to the practical scenario outlined in this question to see how these rules combine. We establish our starting baseline with the accrual-based figure, a net income of $3 million. Our first adjustment is $1.5 million in depreciation on fixed assets. Under our rules, this is a non-cash expense that reduced net income, so we add it back. Next is a $200,000 gain from the cash sale of land. The actual cash from this sale belongs in the investing section, so we subtract the paper gain from our operating calculation. Then we process a $300,000 increase in accounts payable. This represents a liability increasing, meaning cash was conserved instead of spent. We add it back. The final data point, $400,000 in dividends paid on preferred stock, is a trap. Paying dividends is strictly a financing activity, so it is ignored entirely when calculating operating cash flow. Once the adjustments are processed, a $3 million net income yields a true operating cash flow of $4.6 million. The statement of cash flows is an indispensable truth teller regarding liquidity, but it is not an absolute measure of a firm's total health. Its primary limitation is its time frame. The statement is purely diagnostic and backward-looking, making it insufficient on its own for forecasting future profitability. The very act of stripping out non-cash items, like depreciation, effectively reveals cash on hand, but it obscures real, long-term economic costs. Those aging fixed assets will eventually require massive capital outlays to replace. Furthermore, cash flow is vulnerable to manipulation. Management can actively engineer the timing of transactions to paint a highly specific picture for the public. For instance, a company might intentionally delay routine vendor payments until January, artificially inflating the Q4 operating cash flows reported to investors at the end of December. To truly understand an entity, the statement of cash flows cannot be viewed in isolation. It must be analyzed in strict conjunction with the balance sheet and the income statement. Only together do they reveal the unvarnished reality of a firm.